Netflix will be in the spotlight this afternoon when the company reports earnings after the close. Analysts are expecting an adjusted EPS of $6.89 a pop on revenue of more than $11.5 billion. So Netflix shares are up more than 60% over the last 12 months. So let's go inside out on that name ahead of earnings. Joining us now, very pleased to say, sitting beside me is Melissa Otto, head of Visible Alpha Research, S&P Global Market Intelligence. Thank you so much for your time. Good morning.
Hey, Sam. It's great to be here.
And it's always nice to have you. What are you expecting?
Based on Visible Alpha consensus, we haven't seen too much movement in the numbers coming into this quarter. So I feel like that is an indication of fairly stable sentiment. So coming in around $11.5 billion in revenues. I think where we're seeing some controversy is around the ad revenues. Right. There's a pretty significant spread there in the ad revenue expectations. Based on consensus, we're seeing anywhere from $500 million to $2.5 billion in expectations. So that's kind of rounding out, giving us a median consensus of around $1 billion. But I mean, it could go either way. And then what's really interesting is that next year, consensus is expecting $6.5 billion. So I think kind of between now and this time next year, the market is really expecting that business to ratchet up.
Okay. $11.5 billion, though, I suppose, in revenue. I mean, what's going to be the major driver of that? Because obviously we've seen this foray into sort of the live business as well. We want to see some of the numbers coming from that female boxing match that we saw over the summer as well, K-pop demon hunters, etc. too. So, what is it? What is it going to be composed of, do you think? Where's the strength going to come from?
I mean, the backdrop is very interesting at the moment. There's a lot of movement around media companies. Yes. There's some interesting M&A on the horizon. And I think that, some of the content's up for grabs. So it'll be interesting to see who grabs it. Is it going to be Netflix? Is it one of their competitors? Yeah. And, where does this all shake out for them? I mean, the company's been an astonishing stock over the past 3 years. It's been essentially a six-bagger. I mean, is it going to continue to do that for the next 3 years? Investors may be saying, where can I get, maybe a little bit better risk-adjusted return? I don't know. But, that's, I think, some of the questions that I'm hearing out there. I think based on Visible Alpha consensus, $1,400 price target, it's about 15-20% upside from here. So that's kind of where we're at with it.
Yeah, and I suppose you were referring obviously to some of the news we're hearing out this morning. I believe it's CNBC sources who are talking about Netflix and Comcast potentially being sort of interested partners in this whole Warner Brothers Discovery sort of spin-off that we're talking about. So let's see how things go. But I don't suspect, it could be brought up on the analyst call. Who knows? But, as far as moving into the future, you mentioned, where others could be, looking for value. I mean, it feels like a lot of the commentary around Netflix is that they sort of clearly won the streaming wars. So, I mean, what happens next?
I mean, YouTube TV is out there. I mean, they've also got decent market share. Right. But I think this advertising piece is a really important component to how their business model is shifting. The advertising is potentially going to add a significant amount of profitability for the company over the long term. So that $6.5 billion consensus ad revenue number that I explained for next year, I mean, as we think about that over the next, say, 2 to 5 years, what's going to be the impact to margins and earnings growth? And, I think it could be substantial provided that they execute.
Right. It's all about that execution. Okay, we'll be watching out certainly for that commentary as well as how they do in the quarter. Thank you, as always, Melissa Otto, for joining me here on the trading floor here at the New York Stock Exchange. Melissa Otto, head of Visible Alpha Research, S&P Global Market Intelligence. Okay, let's trade it now with Tom White, host of Fast Market. Your first example trade for Netflix, looking neutral to bullish. Tom, what's the approach?
Yeah, a little bit more conservative, maybe a little bit more passive, but you can still take that directional bias because implied volatility levels are really elevated going into this report. Option market pricing in over a 6% move either way. So looked at this a little bit more passive where I give myself a better probability of success. Using that October 24th weekly option series that expires in just 3 days. So this is really short-term positioning, earnings type of trade. Where I'm going to sell the out of the money 1170 strike put. And then against it, because you want to stay risk defined, anything can happen in these stocks. by the 1150 strike put. So a short $20 wide, neutral to bullish put vertical. You're going to collect roughly about a $5 credit. That credit you collect is what you can profit on this trade. So $500 per spread, but you've got $1,500 in risk. But that's all the way below 1150 on this. Now, the break even, if you collect that $5 credit, goes down to 1165 to the downside. That's about 6% below where the stock is currently trading. So you've given yourself that big cushion of success on this one. And you've got a probability that that short 1170 strike is going to be out of the money at expiration, which is what you want, of about 72%. So the probability is in your favor on this one, risking 1,500 to make 500, but you've got that big cushion to the downside.
Okay, and a second example trade for us on this name, looking more bullish. What are you seeing there?
Yeah, if you think this stock's going to get a pop, I mean, the option market price in that plus or minus $80 move in the shares. We see this stock move post-earnings. So if you think it's going to go higher, let's take advantage of the vol dispersion between option series. So I looked at a call diagonal here where I can buy something in the October 31st weekly options that expire in 10 days. I'm going to buy basically the at-the-money 1240 strike call. And then against it in the near-term options, in the October 24th weekly options, I'll sell the 1300 strike call. So a bullish $60 wide call diagonal where you're going to pay roughly about a $29 debit. So there's your risk, $2,900 per spread that can expand to 60, right? You can see here from the risk profile, you want it to go towards 1300, but anything above the break-even level of about 1250 is going to be profitability on this one. Now, why is this cost less than half the width of this bullish $60 wide call diagonal? Because you're buying about a 60% implied volatility, selling about a 97%. So that vol dispersion really lowers the entry point price, but you do need to move to the upside on this one to get above that 1250 break even.
Okay, good look at Netflix there. And I do see that UBS, Wells Fargo, Bernstein and KeyBank analysts all rate the stock as a buy or overweight, very much citing some of that content strength and solid engagement. So let's see how things go for this name later. Thank you so much for that, as always, Tom White, and your example trades.